What's going on, guys? CorbinClaypool here. Excited to bring you another video on FHA loans. I just want to let you know, I just filmed this whole video and my memory card died on me, or there wasn't enough memory. So I'm going to refilm this video, and I think it's actually a good thing because I learned a lot and I'm going to make a better video this time. So let's get into this. So first off, what is an FHA loan? That's the main question people have. They don't know the difference between an FHA loan and a conventional loan, and it's confusing, and there's so many different products and all that. First off, that's why you want to get with a trusted loan officer that can walk you through all of this. But let's get into it. So an FHA loan is going to be a government-backed loan with more flexible lending guidelines. So what does that mean to you? An FHA loan is going to be the perfect fit for one, a first-time home buyer, and two, for somebody with credit in like the 600s, maybe low 700s. Sometimes, most of the time when you cross that 700 mark, you're going to be looking at a conventional loan. It's going to be a little bit of a better loan for you typically. But if you're in that 600 mark, then an FHA is going to be your thing all day long. So there's nothing wrong with an FHA loan. A lot of people don't like FHA loans, or they've heard bad things about FHA loans. And let me tell you, FHA loans are great products, and sellers, when you're buying a home, shouldn't be steering away from them because FHA loans, to be honest, are easier to get done than a conventional loan. So let's kind of get into some of the different requirements and the different factors of an FHA loan that make things a little bit different. So first off, when we order the appraisal on an FHA loan, it's going to be more particular. A conventional loan will let some things slide. An FHA loan is more particular. So I'm actually going to post this below. If you want to look and see exactly everything about the FHA appraisal requirements and all that good stuff, then check the description because there's a link in there and you can check it out. But in a nutshell, the main things are going to be like cracked windows. Cannot have cracked windows. Chipping, cracked, peeling paint. Can't have any of that. Can't have termite infestation or water damage or anything like that. Those are the big main ones. There's other ones as well that I don't see pop up as much, but those are like the three main ones that consistently pop up. And of course, if you don't have a monoxide detector, please put a freaking monoxide detector in there. And oh my gosh, it drives me crazy, right? Like you get the appraisal back. I'm going to go on a little tangent here. You get the appraisal back, and then all of a sudden you find out the monoxide detector wasn't in, and the client has to pay $150 just to send the appraiser to go back out there to check that the monoxide, detector is installed. And typically, guess who ends up eating that cost? This guy right here. So come on, let's do better. But in a nutshell, that's what's going to be required, and that's the differences on an appraisal. So take a look at that. When we look at the FHA loan itself, what's different? Well, there's a couple things. One, there's a thing called mortgage insurance premium on an FHA loan. Okay, what is that? And that's different from the mortgage insurance. The mortgage insurance premium is basically going to be added onto your base loan amount. It's just part of an FHA loan, okay? So let me give you an example. And let's just follow along with me here on this loan estimate. If we have a purchase price of $375,000 and your down payment is $13,125, why is my loan amount, if you can see at the top there, $368,208? That's one of the most common questions we get asked on an FHA loan. And the reason why is because they're going to take your base loan amount, they're going to multiply that number by 1.75%, divided over 12, and then that number is going to be added to your base loan amount and is going to give you your total loan amount on an FHA loan. So that is why there's that difference there, and that's called FHA MIP. No other loan has that. VA has something similar called a funding fee, but it's not the same thing. Now let's kind of look into the monthly payment and the cash requirements on an FHA loan. So this is based on a sales price of $375,000 and an interest rate of 4.25%. That interest rate is going to be important determining your monthly payment. So your monthly payment is going to include your principal and interest of $1,811, your monthly mortgage insurance of $253, which, by the way, is different than your FHA MIP, your property tax of $390, and your homeowner's insurance of $109, okay? Equaling a total payment of $2,565, roughly. So that's with everything included. So a lot of times you'll go online and you'll look at an estimate or on Zillow estimate, and it won't include all these different things. So you'll see principal and interest of $1,811, and it's like, oh, that's great. That's an awesome payment. That's where I want to be. But then everything else gets added back in when you go to your loan officer and you're like, what the heck? Why is my payment $700 or $800 more, right? So that's really an important factor to look at. What are the cash requirements on an FHA loan? So if we look at this loan estimate here, you can see the down payment is roughly $13,125. The closing costs are around $3,900 roughly, and the prepaid costs are going to be around $4,600. So this is just an estimate, guys. It could be different, but let me give you an idea of the difference here. The closing costs are going to be your lender fees, so underwriting, processing, your escrow fees, title fees, notary fees, appraisal fees. All those different fees that you're going to pay are going to be included in that closing cost section. The prepaids are going to be basically like your upfront homeowner's insurance. It's going to be your taxes, because we're going to impound your taxes in an escrow account so that there's enough money in there when the county tax season runs around, you can get that paid. So on a $375,000 home, you're looking at roughly around $21,735 or $22,000 or $20,000. Just depends on the lender, and it can differ usually by maybe a couple thousand or $1,000, just depending. And sometimes you may be doing points, so you may be buying down the rate a little bit to get a better rate. So that gives you a rough idea of what the monthly payment is on a $375,000 purchase price. You can actually go online if you would like and go into Zillow Mortgage Calculator. There's a really cool app, and you can download the Zillow Mortgage Calculator, and that will give you a rough idea of where everything is at. The next thing I want to talk about are the loan limits. So that's another difference in FHA loans versus conventional. Conventional loans have loan limits as well, but FHA loans have lower loan limits. So for example, in Fresno, the loan limit is $420,680, right? So what does that mean? Does that mean, Corbin, I can't go buy a home for over that? No, it just means that your down payment has to make up that difference. So if you buy a home for $435,000 and that 3.5% down payment gets you below that $420,800 mark, well, guess what? Now you qualify for an FHA mortgage. So there's actually different limits for different counties. Most counties are following the Fresno County 420 roughly, but other counties like LA have much bigger options like $970,800, which is significantly different. So I'm actually going to post a link below where you can look up your county and you can see what your FHA loan limit is. So another question is, what types of FHA loans are available? So first off, FHA loans are only going to be for a primary residence, okay? It's not going to be for an investment, and it's not going to be for a secondary. You can purchase and you can refinance. Now there's some other options within those refinance options that you can do, like a streamline or a simple or a rate and term, but we'll do those, breaking them down in other videos, kind of going over that. So if you have more questions on the mortgage process or FHA loans or convention or anything like that, please like, subscribe, hit the bell icon, guys, because I'm going to be doing these videos weekly, hopefully, and putting out consistent content for you to go over everything mortgage, basically, and real estate investing and maybe some cars. We'll see. So here's where FHA loans shine, the credit score requirements. So when you're doing a conventional loan, it's very particular on the credit. It tells you can qualify for 620, but like I said in another video, check out that video if you have questions on what it takes to pre-qualify for a mortgage. But even though conventional loans go to 620, it doesn't necessarily mean it's going to qualify for 620. FHA loans are different. FHA loans will do low 600s, above 580, even below sometimes in certain circumstances. And they're actually pretty flexible with it, and they're not going to kill you on the interest rate. Whereas a conventional loan, if you have a 660 credit score and you're qualifying for a conventional loan, well, got some news for you. Your credit score or your interest rate's probably not going to be the best, or you're going to be paying maybe some points that you don't want to pay to get your interest rate. That's just kind of the nature of the beast of conventional loans. They don't like anything below 700, and even below 720, they don't like. They want 720, 740, 760. They want that best credit score to give you the best possible pricing. FHA is different. FHA is down. They give you a great interest rate, even at a 640 or 620 credit score. So that's a very beautiful thing about an FHA loan. Now, talking about credit score requirements, there's going to be some differences. One being, if you're in a community property state like California and you're married, even if it's not amicable, even if you're not talking to the person and you're going through a divorce, but it's not finalized, FHA loans are going to require that we use the spouse's debt against your debt to income ratio. I have seen nightmares with this where the loan officer doesn't get this. And by the way, it's happened to me. It does. It happens to every loan officer. Things happen and pop up that you were unaware of, right? There's guidelines changing all the time and things that are out of your control that pop up. But in a nutshell, we're going to have to use that spouse's debt against your income. So make sure that it's amicable enough to where you can have the lender pull a credit report for your spouse to add that in. Make sure you tell your lender about that stuff too, because sometimes people try to hide it and it always gets caught. Another key thing about an FHA loan on the credit score requirements is we're going to pull up a thing called a Caivers report, which is also very important. Okay. You can look that up. It's CAIVRS. Caivers report. It's a great tool to really look in the background of federally owed debts and things of that nature. That's another thing on FHA loans. They do not like you being late on federal debts. It is a government loan after all. Okay. So if you have late payments or you have an outstanding balance with a federal student loan or something of that nature, that can kill your deal. And you may be required to settle that before you close. Another key thing is collections. So on a FHA loan, if you have collections over the amount of $2,000, you're going to have a few different options. One, maybe you can just be hit for 5% of the balance and you still qualify with your debt to income ratio. So basically what that looks like is we take 5% of, let's say, $2,500, and then we're going to use that against your debt to income ratio or against your income. The other option is just to settle it and pay them all off when you close. And the third option, which is kind of a last resort, is to set up a payment plan, because maybe that payment plan is less than that 5%. And if we have something in writing showing a payment plan, well, guess what? We can use that for you. Another nice thing on FHA loans, like I mentioned, it's a little more flexible, right? Is a bankruptcy only has to be seasoned for 2 years on an FHA loan. And actually, in some circumstances, a year. If you're in a Chapter 13 and you've been making your payments on time and you haven't missed a payment, then you can qualify after a year on that. The other piece is on a foreclosure. If you unfortunately foreclose on a house, that's a really sad, bad circumstance. But the cool thing is on FHA loans, as long as you've basically established new credit and you're 3 years out of that foreclosure, then you can purchase another FHA loan. You may not be able to purchase a conventional or anything of that nature, but you can actually buy a house on an FHA loan after 3 years. Let's talk a little bit about assets. What can we use to close on the home? So of course you can use funds that you have, which is preferable, right? You can use your checking account, your IRA, your 401k. You can use money that you've saved up. You can get a gift from a family member like a brother or a sister or a parent if they're going to give you a gift for your down payment and closing costs. So there's definitely some options that you can use. If you have cash under the table, which is a problem sometimes, here's a little key thing on an FHA loan. You can deposit a little bit of your money every single day and it won't trigger anything. Now, if you go deposit $10,000, it's going to be required to be sourced. But there is a little bit of a way around that, and that is basically depositing a little bit every single day, and you can kind of usually get around those guidelines. You know, there's also grant programs that you can look at, or down payment assistance, or maybe your local county has something sometimes. Those are also eligible on an FHA loan. So there's a lot of different cash to close options. Speak with your loan officer and they'll be willing to walk you through and help you out with that. And last but not least, is the FHA loan only for first-time home buyers? Absolutely not. There are situations where somebody had great credit and they purchase a home on a conventional loan, and then all of a sudden, unfortunately, something happens with their credit and they want to go buy another home. Well, maybe you guys have to buy it on an FHA loan. And one critical component to this is you can do that as long as you don't have another FHA loan. So you can't have two FHA loans at the same time, but you can have a conventional loan and an FHA loan. So it goes the other way as well. So if you have an FHA loan that you bought, you can buy another property with a conventional loan and keep that FHA loan and keep that property and maybe rent it out. So some creative options with an FHA loan that I like is the seller can contribute up to 6% of the purchase price towards your closing cost. So what does that look like? Corbin, if the closing costs are only 2 to 3% of the actual purchase price, why would I need 6%? Well, if you get a full 6%, which is probably pretty unlikely to be honest, but let's say you do, you can take that extra money and pay points to buy down your rate. and use that seller credit to pay for those points so it's not out of your pocket, so you can get a lower payment and a lower monthly interest rate. Rates are also really flexible with FHA loans. So what I mean by that, on a conventional loan, there's not much of a margin for the lender, but on an FHA loan, there's a much bigger margin. So typically, you can actually increase your interest rate a little bit and take a lender credit back if you would like to help cover your closing costs. This does up your payment because you're upping your interest rate a bit, but maybe you have plans to refinance into a conventional loan in the future, or things of that nature. And my favorite part about an FHA loan is it is the only loan that can purchase a multi-unit with a minimum down payment. This is actually how I purchased my first investment property, guys. I purchased a multi-unit with a minimum down payment of 3.5%. And you can live in one unit and you can rent out the other 3 units. And then after a year, if you decide I want to move, you can move from that property, keep that FHA loan with a minimum down payment, and have a fourplex and a great investment purchase. And I missed one thing, the mortgage insurance. One really key critical component of an FHA loan is the mortgage insurance, of course, like I mentioned. The mortgage insurance on an FHA loan with a minimum down payment doesn't come off of the loan. But here's the reality. Even if you're buying a conventional loan with a minimum down payment, guess what? You're still going to have that mortgage insurance on the loan for many years. So the thought is this: you can do an FHA loan, you have the mortgage insurance, you work on your credit, you get your credit in a better place, you get equity in the property while you're paying down the property, and then guess what? You refinance into a conventional loan and remove the mortgage insurance. So there are ways out of the mortgage insurance on an FHA loan, but they are stuck for the life of the loan. Hopefully this video was informative, guys. I'm hoping to keep releasing better and better content and growing and doing better. So if there's any feedback that you have, please comment below. Let me know. Like, subscribe to the channel, guys. Hit that bell icon. I'm excited to keep bringing more content. And the next video I'm going to bring is going to be good. It's going to be talking about the Fed fund rate and why it didn't affect mortgage interest rates and why mortgage interest rates actually got better and why I think they're going to continue to get better. So have a great day, guys. Talk to you later.